Good afternoon, BFX community. We're actually back with one of our earlier guests who is extraordinary in his own right, purely due to his financial insight and genius. We're talking once again with Elio D'Mato from Stockopedia. Elio, welcome back.
Yeah, great, Ross. And look, thanks very much for that very kind introduction. Although if it's any comfort to anyone who may not consider themselves to be geniuses, when it comes to investing, look, to be frank, I know people that you'd be flabbergasted to think they could actually tie their own shoelace, but they're somehow successful in the share market. So, folks, the two aren't something that you necessarily need in order to be successful. Anyone can do it. It just takes a little bit of discipline, and we'll talk a bit about that today.
So, Elio, we were in September. We're in early October, and I think that there's two fantastic things about September. There's the footy finals, and there's also the dividends.
Yeah, well, I suppose it's about perspective, though. I mean, the month of September was a terrible month for the All Ordinaries, and Collingwood won the grand final. So, to be frank, couldn't have had a worse month if you tried. But you're right, though. Dividends did definitely soothe the soul because, of course, though companies go ex-dividend a lot earlier, they actually hand over the cash, as it were, in the large amount around this month. So for those with a dividend focus, it's definitely time to cash it in.
Why are people cautious of shares? So the biggest investment most people make is a mortgage or a home loan. Why are people cautious of shares? Why do they steer away from them, or why do they jump ship when the market drops?
Yeah, it's a bit of a combination of things. I mean, the first is that we've made them to be somehow these mystical three-letter codes that float around in space that sort of go up and down on reasons unbeknown to anyone. And those factors and drivers are, often never come to light, but somehow the price or the value of our actual asset is fluctuating wildly on a daily, weekly, or even monthly basis. And then there's the old adage of control. Because, of course, with your property, if there's something broke, you know when to fix it, where to fix it. You have an element in regards to control as to what you do with your property. Whereas with shares, there is a board elected for us, and that board acts as our representative. And, of course, notwithstanding that they're all great men and ladies on the board trying their very best in the interests of shareholders, unfortunately, we don't get to control those outcomes. So, really, it's that lack of control because, of course, the board does appoint the CEO, the leaders of the company, the executive, as it were, that then go about and try doing their very best to grow profits and do all those things that we hope that happens to our companies, which is why we invest. And I think that's the third element there, that, again, because of these complicated people that have done their PhDs and all their doctorates, and we've all done postgraduate studies, and we've learned how to, value a stock within an inch of its life. And most investors will sit there and say, well, how can I get an edge ahead of those types of people? I mean, they're looking at the market every day, every second, whereas I have another job in my life. I have to dedicate my time to family. I have a hobby. I can't analyze the market all the time. So if I can't get an edge ahead of everyone else, then what's the point of me actually investing in the stock? I might as well leave it alone. But I think what investors need to remember is that whether you invest in BHP or mum and dad's fish and chip shop, it doesn't matter. The same factors are at play. You have revenues, you've got your expenses, and then ultimately you hope at the bottom there's a profit from which, of course, you then receive those wonderful dividends that you were alluding to. It's just that the scale of each of those two companies is significantly different, but the underlying drivers are the same. And as an investor, if you can break it down into a much more simpler level, you'll find that it becomes far more fruitful, and you'll feel a lot more in control when it comes to selecting stocks, as well as have an ability to block out the noise and keep that noisy rubbish out of your head.
Would a good strategy be for someone starting out, obviously, to get a subscription to something like Stockopedia, where all the numbers are broken down and much easier to understand, and they can consult with the experts like yourself? Would a good strategy be, so they talk about growth stocks and income stocks.
Mm-hmm.
Would it be good to get a combination of both? So just say, for example, one of your stocks, the price is down and you're worried, but you can't pick when it's going to go up and when it's going to go down. But what you do know is that historically that company will pay you a dividend.
Yeah, look, we'll unpack that response there. I mean, obviously, I have a vested interest in this, and I would suggest that everyone get a membership to Stockopedia. But pragmatically, I do need to say that the vast majority of investors tackle the share market initially by depositing their life savings into there, and then they realize that they need assistance. I don't know why they do this. It's akin to jumping off a cliff and then realizing halfway down, maybe I should have put a parachute on, rather than thinking you should have needed the parachute before you actually took the leap of faith. So being, forewarned is forearmed, as they say. Understanding what your companies are doing is crucial. But even before then, most investors will be very upset with the share market because inevitably they put it all on one stock and it goes pear-shaped. So the obvious impression is that the share market's risky and it's very challenging. But I often put to those investors that what's the problem is not the stock they invested in, but rather it's the strategy that they employed. And understanding what strategy you actually want to employ before embarking on investing, even in your first share, is vital. Because there's nothing worse than investing in a company, not really understanding why, and then having the consequences of that and not knowing what to do. Because if you're asking yourself, what do I do now? It's already probably too late. Inevitably, the reason why you get into a stock is the reason why you get out. And that will only be defined by the strategy that you decide to employ. So people like Stockopedia and other providers out there, we spend an inordinate amount of time in helping investors understand what it is, what their strategy is, how are they going to tackle the market. Once they do formulate a view and an opinion as to how they want to do it, then our job is to direct them to where the fish are, as it were. So rather than worrying about the 2,000 codes that are on the stock exchange and each of which have these wonderful stories attached to them, getting to the bones of it, looking into the soul of a business, understanding the numbers and understanding how those numbers align to the strategy you wish to employ. And if you want to invest in stocks that pay reasonable dividends that are growing, in order to either choose to reinvest those dividends or alternatively use them to fund your own particular lifestyle, then that's great. So you need to make sure your company is high quality, that it continues to generate those strong earnings, strong cash flow levels, because of course, dividends come from cash. Once you know what you want, you'll then know what to look for in your business. This is part of the whole demystifying thing that I think having a provider by your side helps with. Because of course, I mean, we all get, any mug can pick a stock, right? We can all go out there, read the newspaper, open up our social media channels, and there'll be 1,000 stock recommendations. However, managing money is the bit that elevates a mug punter to an investor. And if you can be an investor, understand your strategy, and then be able to know what to look for in order to support that strategy, you are already starting light years ahead of the pack. And in a far likely more position that you'll be able to achieve success relative to what your definition of success is. Because of course, for many people, it's different. And often that definition of success will determine how much risk they're willing to put on the table, which in recent years, those that took a lot more risk have unfortunately suffered.
Would you say time frame's one of the biggest lacks in people's strategies? So Andrew Pridham from Moelis talks about those that check their stocks too regularly. He said when he plants a tree, he doesn't go out every day to see if it's grown, and he uses that strategy with his stocks. Would that be one of the problems too? So someone invests in 3 or 4 shares, the market does something funny, and they think, oh shit, I better get out, when they would have had a strategy of, well, hang on, I've had them in for 3 months. I've got a 5-year strategy. This is a blip. I'll ignore it and continue on.
Well, of course, whilst you might not look at the tree every day, I sincerely hope you go out there and water it regularly. Otherwise, the thing's going to die. And that's an important reality for DIY share investors, that this is not a set and forget strategy. There's various things out there like ETFs, or if you're brave enough, you might try to go for an active fund manager who professes that they have an ability or means to outperform a broader market. But that's if you want a hands-off strategy. However, if you do wish to remain in control and make a decision, then looking at your stocks regularly is pretty much part of the course. The question then becomes, what is it that you're actually looking for? Now, of course, yes, if you're trying to assess the size of every bud or new leaf that's coming out, that's probably not that useful in regards to your time. Whereas if you're looking for the key elements, like is it taking root? Do the leaves look withered, or are they nice and plush so they are getting enough water and enough sun for that matter? Then that is, of course, something you do need to do. And I think, yes, time frame is interesting because, of course, when you have big periods of correction like we had during the GFC, where it was 14 months from peak to trough, go back further in 87, where it was a pretty significant fall in the market, more recently during COVID, although that was a very rapid V-shaped recovery, not seen before in our market, so quite unusual. So inevitably, us learned views will come on and will say, oh, yes, don't worry, over the long term, it's fine. But of course, the question is, how long term is your long term? And it's not for me or anyone else to define that, because, of course, you may have a need for those funds for whatever reason. And you may not have the liberty to lock it away for 5 years, hoping for better performance. Though in my experience, I've often found that when it comes to active managers or stocks, even for that matter, that if they're terrible to start with, then time doesn't really help them anyway. They just pretty much taper off and they remain where they are. But what we need to do is we need to be, proactive passive, as it were. That we still need to be demanding of our businesses and our stocks. That's why we direct invest. That's why we go to the trouble of holding these 3-letter codes and paying a broker to buy and sell them and do all that sort of thing. So we still need to be proactive over those businesses. Are they still meeting the reasons why we bought them in the first place as aligned to our investment strategy? And then if they are, the ideal situation is that you have an owner-occupier stock that you never, ever have to sell. It becomes one of those locks in your portfolio and you never, ever have to worry about it. Reality is, it's probably only that many of them out of the 2,000 that are out there. So more actively or more usually, as it were, we actually do need to make regular decisions on our businesses. Doesn't have to be every day, doesn't have to be every week, but definitely on a periodic basis, ensuring that your stocks still meet the mandate, blocking out the price movements if you're that way inclined. Or if price movements do cause you heartache, then you do need to look at them more regularly and protect your capital. And this really, again, comes back to my original point, sorry for the long-winded answer, and that is once you know who you are, how you want to roll, what is it that causes you to stay up at night, you can then go about investing in that way that aligns with that, rather than being, that square peg in a round hole where you're being told all this noise, but then you're thinking, no, that doesn't really suit me. And I'll give you an idea on this, a personal example. So myself, I have a very strong history in quality investing, or a style of quality investing, where we look at things like return on capital employed, return on equity. We look at cash flows of a business, financial health, business risk, all that sort of thing. However, when I decided to become a self-managed unemployed fund, way back 3 years ago, a SMUF, as I like to call it, it then became very important for me to protect my capital, because I wasn't having a direct flow income coming in on a regular basis, where I could probably pick a wrong stock and then go, it doesn't matter, I'm still going to get paid, I still get to eat. Whereas when that changed, I couldn't do that anymore. So I had to become more protective of my capital. So therefore, I introduced a momentum element into my overall strategy. So I balance quality and momentum with regards to the way I invest now in order to look for those good businesses, because good business tends to beget good business. But I also ensure that there's momentum because I want to protect my capital, because I might not have the time, inclination, or patience to wait for a stock to bounce back from a 50% drop to go up 100% to get back to where I was. I want to try to find those stocks going northeast rather than overcomplicating the issue somewhat. And I can do that as a direct retail investor.
So how regularly would you be reviewing your own personal stocks?
Okay, now I'm a stock nerd, so this is a little unfair, but I look at mine multiple times a day, as I'm sure you probably had a little bit of an inkling there, Ross. But from a pragmatic perspective, if you're a normal person, and I use that in quotation marks, of course, if you are normal, look, once a week is generally enough to at least run your eye over, but I would say a serious review on the portfolio at least every quarter. And I say that because generally over a quarter, you will get announcements from a company. They'll give you things like sales updates or business updates, or they've won new contracts, or they've done new deals, et cetera, et cetera. So these updates are our manner, right? Otherwise, we can't walk into a company and just arrange. Well, with some you can, but very rarely can you walk in and organise a meeting with the MD and say, hey, just have a chat. How's the business going? Tell me, are you shooting the lights out, or are you missing budgets? What's going on? That information generally is not available to us. But what we can do is stay abreast of these updates so that every quarter we can reassess the portfolio. Remember, why did I buy it? Aligns with the strategy. Is it still meeting that strategy? Yes or no? Because if it doesn't, then you just have to get rid of it and find someone else that does. If it is, then great. Happy days. You lock it away and you don't have to worry and stress anymore. Unless, of course, you're a momentum investor, which means you do look at the price, which means then generally you do need to look at it probably on a weekly basis, and you probably put a little less emphasis on the business updates because, of course, let's face it, company directors are just glorified marketers. And often they will always put a positive spin on thing when they do have the opportunity to do so, which is why when you see a negative announcement from a company, you should probably listen, because inevitably it's not as bad. It's actually probably worse than what they wrote in the headline, which can be pretty bad. And hence why you see those big sell down days, because often the market's a little skeptical. And being a skeptic is a terrible character trait in life, but it's great in the share market. I found it a very profitable one myself.
What place does emotion have in investing?
None. Got to be ruthless. You have to be ruthless. If you use charts, that's incredibly ruthless. If you like value, for example, often a share price has to fall in order for value to be created. Now, that means you're often buying into a stock that has been beaten down. It's got inherent problems, or there's some issue that's created that value, and you have to block that emotion from making the decision based on that. Quality investors will benefit from quality compounding. But if quality is not compounding, you have to actually detach yourself from that decision-making process and think of the business as that rather than a personal family member. And I often used to joke, if it helps, start giving your stocks family names. Oh yeah, that's Auntie Betty and there's Uncle Joe, because that just shows you how nonsensical it is to actually attribute emotion to your investing. Stock, one of the great liberties we have as direct share investors, not as fund managers, that's a different discussion like I used to be. But when we're direct investors, to make a decision on a stock is an instant decision. And in fact, the decision to do nothing is still a decision. That's the other interesting point. But we can literally buy and sell stocks, and then within 2 days have our settlement achieved. Now, you compare this to property, where, of course, you don't know what price you're going to get because there's no market. You have to leave it to the gods a little bit. And then even when you do sell it, you then have another 3 to 6 months in order to get that property settled, as it were. Whereas with the share market, you don't have that problem. And if investors understood this one basic point, in that if they're wrong, no one's going to make fun of them. Many investors won't actually click sell because they're worried that they're going to have to buy the stock back at a price higher than what they sold it at. And here's the thing, when you sell a stock, it's like taking insurance. I mean, I don't go home every evening to my darling wife and say, geez, honey, what a shame you didn't get to claim on my life insurance today, because when I die, you're in for a great payday. Of course, that's just stupid in terms of an ideology. And you just need to think about that. It's the same way with your shares, that if you sell, have your money in the safety of cash, all you're doing really is protecting any worse further potential downside. Happy days if the thing goes up again, then you can buy back in and go on your merry way if the stock's making you particularly nervous. But yeah, the emotion one, it's the hardest thing to master. In fact, the more you get involved in shares, the more difficult it becomes, much like a relationship. So therefore, if you are able to be cold-hearted from the very get-go, or at least approach things pragmatically. Almost, do the Mr. Spock method of investing. Try to use logic when it comes to that, because often in the market there's many illogical moments, and if you're able to cut through that noise, that can be exceptionally profitable in the hands of the right investor.
On that topic of illogical, how often do you see prices do silly things because of irrelevant announcements or trends that people have perceived in the media?
Oh, every day. I mean, look, we've talked about bubbles before. I'm sure your other guests have spoken about bubbles. I mean, whether it's AI, whether it's virtual reality, whether it's lithium, for example, or whatever the case may be. That's not to say, now, I don't want listeners to confuse this with this idea that they'll never be a thing. Oh, by all means, I'm sure one day we'll be all living in virtual reality land rather than actually talking to other human beings, because we're stuck on our phones or got one of those fancy things on our head. Whatever the case may be, however the future looks, that's fine. But often the market prices things for tomorrow, today, and that becomes a risk. And I'll use a more real-world example, like a mining stock. So a mining stock will generally, the share price will do nothing for a very long time. There'll be day traders getting in and out and a few other things. And then all of a sudden, they drill a hole and they find something. And guess what happens to the share price? Up it goes like a rocket. Now, of course, what then happens is it goes up to a certain level because everyone automatically thinks, oh, wow, they found this gold. This is how valuable the business is. But the reality is, from that drill bit first being drilled to when it becomes an operational mine, if it's lucky enough to get to that stage, is a 6 to 7 to 8 year process. So what happens? All that excitement over 8 years encapsulated in this one moment, what do you think happens with share price afterwards? Tends to come down afterwards as the reality kicks in. People who have made money on the way up start to get out because they know it's a long time till eventually this thing starts to operate. People who bought at the top start seeing they're losing money, so they get worried. What do? They invoke their insurance policy and they go to cash. And then you get that selling pressure. It's something that is known as the Lassonde curve. It's actually a phenomenon that was studied by a French professor many moons ago. And it's often how we use that hype and that moment that can drive prices up really high, and then eventually they'll come crashing down. The Mount Fuji share price pattern is another way I like to refer to it. But then, of course, you get the opposite, where share prices will plummet in what would seem like an innocuous comment or result, and all of a sudden the share price falls 20 or 30%, and you're left scratching your head. Why is that? Now, of course, we don't have a direct line as to why every investor is selling. They'll sell for their own particular reasons based on whatever reason they got in will determine why they're going to get out. But when we see moments of that disconnect, if we do have the emotion or do have the ability to control our emotions, if we can employ the Dr. Spock method, be cold, ruthless in regards to our decision-making process, and we've got a strategy that allows us the time required to recoup and sort itself out, then by all means, that creates opportunity. And I think the market investors need to understand this, because if you're just looking at the same data everyone else is, you're only going to get the result everyone else does. But to outperform the market, you've got to do something different than the market. And often that means controlling your emotions, blocking out the noise, and making a cold, calculated decision when the market does its irrational thing, which, last point, is just the market acting normally. The market's always irrational, either over-exuberance or over-pessimism. And the reality is often somewhere in between. And again, if we can master that, we're already started on the right foot to be a successful investor.
So as Warren Buffett said, when everyone's running out of the burning building, you run in?
Well, once it's doused, of course. I don't know whether I necessarily do that. But of course, no, there is that saying that, be greedy when others are fearful and fearful when others are greedy. And obviously that very much plays out in many, many different scenarios, not just the share market, if you really think about it. And again, this is where my earlier point that the share market is a reflection on life and business and what occurs in your daily environment. All those factors that drive your local business are the same that drive big multi-billion-dollar businesses, just on different scales, of course. And therefore being able to, really sit back and be pragmatic about things rather than being overly concerned about price, which is just a vanity contest rather than anything that relates to the business value. Well, then that, again, that's where you will be far better for it. But ultimately, though, this is not a war cry to hold stocks at all costs, because if your stock's got to be sold, then sell it. Right? If it doesn't align with the reason why you got in, and now it's a different beast than what it was when you did initially take those steps, then you get rid of it, because there's nothing worse than punter's lament. And the only way you'll ever get rid of that is by having a structured and defined strategy that allows you to pick stocks and reject stocks based on that, keeping your emotions in check, of course, built on logic, and allowing you to act in that cold manner I talked about.
So, Elio, say you have, 8 strategies that you go by for picking your stock, and your stock must stay within a majority of those. If you can stick to those strategies, your negatives and your positives and all your in-betweens, if you can block that out and stick with your strategies, that's what's going to do you best, isn't it?
I'll give you an example. We'll go to one of the ETFs. I think it's IVV. IVZ, I should say. That's an ETF on our market that invests in the ASX 200. So basically every stock in the ASX 200 and its weightings are all put together, and basically they yield a return. Now, up until August, that ETF achieved 9%, positive 9% for the year. Pretty impressive. However, within that ETF, there was one particular stock by the name of BrainChip. Now, BrainChip was added back in June 2022 and was actually kicked out this month of the ASX 200. The stock had fallen 75%. Now, this one stock was in the ASX 200. So in theory, the ETF that covers the ASX 200 has it within it as well. Now, do you think investors in this ETF who achieved 9% for the year are particularly worried that this one stock went down 75%? Of course not. I mean, sure, it would have been better if it didn't happen, but they understand that they're exposed to the broader market, which means it's warts and all. But as a collective, the stocks do quite well. So in a way, if I can go back to your question, I think 8 strategies is probably a little too keen, Ross. It's a little keen even for me. Even if you whittle that down to, say, 4 at the most, I would suggest. But even if you go with something as basic as 2, that is exactly the reason why you would do that, for just what you articulated, because at times quality factors will do better for the market. At another time, value factors will do better than the broader market. Say, for example, after the COVID correction, where we fell 35% in literally the space of, a blink of an eye, there was value everywhere. Blood on the streets, as they say, which is the perfect time to buy for a value investor. Benjamin Graham would have been rolling in his grave in excitement, seeing all these stocks at bargain basement prices where he could possibly buy them, and all he had to do was control his emotions, make sure the cash was still generating, or make sure the business was still generating cash above its value. Hey, happy days. And therefore go into those sorts of companies. And then there's times where momentum is doing really well. That's definitely not the time at the moment. Momentum strategies work in 2 market conditions, either when the market's going up or when the market's going down. Momentum really struggles when the market's going sideways, because, of course, you're going in, out, in, out, in, out, chopping, changing. You're paying brokerage. You're paying for their holidays rather than actually making any money yourself. So having different strategies is a great way to smooth out that factor cycle, as it were, where you can then allow, okay, well, yeah, sure, this one's not doing as well, but then I'm sure in 6 months' time or 12 months' time, it's going to be the inverse in the other. And therefore, as a money manager, which is what you are when you're managing your portfolio, you're then making a risk-adjusted decision where you're saying, look, it's not just about returns at all cost. It's about understanding, adjusting that potential, or adjusting your expectations somewhat by considering risk and the fact that not all things go northeast at the same time. And therefore having that diverse strategy base allows you to better manage that.
Elio, before we go, could you give me 3 key points? Someone's got, I don't know, $10,000. They're interested. What are 3 key things they should think about before they dip into the market?
1, always remember that it's never the stock's fault. It's often the fault of the strategy. So remember that. 2, once you understand what your strategy is, you have to limit your universe. Analysis paralysis hurts a lot of investors when they start out. Limiting your universe to a collective of stocks is a great way to block out all that macro noise that's out there. And then 3, develop some internal discipline, because often it's not the strategy that someone selects that kills them. It's their inability to follow that strategy with discipline that hurts them. So just to all recap: 1, define a strategy that works for you. 2, then have that discipline to be able to invest with a strategy. And then 3, be consistent and be discipline aligned to that, and don't deviate. Even when you have periods of underperformance, remain focused on the main prize, whatever it is: capital growth, income, preserving capital, whatever the case may be. Focus on that, build the right strategy aligned to that, and then stick to it with discipline. The numbers will eventually fall your way. And I can tell you, because I've seen it before, it won't matter what strategy you employ, you will succeed. It's just like I said, it's those that start one way, change half flow, eventually they start freewheeling, and that's literally when you really start to struggle in the share market.
Elio D'Mato, we are really thrilled that you have been able to join us again today. And thank you for putting a bit of a simpler spin on what can be a market that can completely make people's heads explode. Thank you very, very much for your time today on this extraordinary simplification of the stock market.
No, thank you very much, Ross. And yes, folks, it actually doesn't have to be that hard. It really is quite simple.
Thank you, Elio.